Fool me once, shame on you. Fool me twice, shame on me, as the old saying goes. The question we want to answer today is Nikola going to fool us twice? So the first time around, the former executive chairman and CEO was convicted for making false and misleading statements to retail investors to drive investor demand. Sounds familiar? That's pretty much what most SPACs did, in my opinion, and it's surprising that Mr. Milton was singled out and sentenced to 4 years in prison for lying to investors in social media, television, podcasts, and in print. Now, Mr. Milton wanted to blame this on his one-quarter Indian heritage, but now he's on the warpath to take back Nikola. You see here this statement on his LinkedIn, currently taking a break from social media to focus on family. I guess that's what they call it. Now, here are some accusations leveled at Nikola as it exists today. For approximately 4 years, the board, led by Steve Gursky, has overseen a staggering and consistent decline in value. Well, that's true enough. Operational underperformance, product liability concerns, trucks burning down, breakdown of one of their key partnerships, value-destructive acquisitions. The list goes on. These accusations, whether they're true or not, need to be taken with a grain of salt because they're being leveled at the company by Mr. Milton, who is attempting to get control of the company again, and it's all a bunch of drama. These things distract from execution. So a quick comment on this. For us, that's a showstopper. So when you have a former CEO and chairman and founder who's convicted of fraud, the apple doesn't fall far from the tree, so we just don't look past that. For those who can, management needs to be credible. You need to be paying very close attention to what they say. One would hope the drama's behind them. It isn't. That's why we mentioned that. Now, we take the same approach to all burgeoning EV companies. How many vehicles are you selling, and are you selling them for more than it costs to produce? Now, when we look at manufacturing, we see that they're capable of producing lots of units. So their phase one, which was completed in the first quarter of 2022, allowed them the capacity of 2,500 electric vehicle units. So Nikola produces 2 semi-trucks, 1 electric only and 1 fuel cell and electric. Now, phase 2 of their production, which started in the second half of 2023, allows them to produce 2,400 units of their electric and fuel cell vehicles per year. So they're now producing trucks. How many are they selling? Not very many. So when we look at the financials, we see that during the last quarter of 2023, they delivered 35 hydrogen fuel cell electric trucks for total revenues of $12.5 million. You see here in the entire year, they had about $30 million in sales. And they say here for the first quarter of this year, they expect to deliver between 30 and 35 trucks for revenues between $12 million and $14 million. So at this pace, we're looking at 140 trucks a year. Assuming a $400,000 price tag, it's about $56 million a year. Now, the real problem here is one that should be glaringly obvious to people who subscribe to our investing methodology, which says that if you're selling something for less than it costs to produce, you don't have a business. Now, look how bad those gross margins are. So they're way in the negative, somewhere around a 260% negative gross margin. We'll talk more of that. Now, before we get into that, I just wanted to point you to our Nanalyze Weekly newsletter. Wyatt's going to put a link to that in the description of this video. Please sign up and support our work. Now, getting to that positive gross margin in their last earnings call, they address that, which is good. They talk about variable cash costs of $679,000 per truck. So let's just assume a $400,000 per truck sale price. So that alone means that they'll never be able to sell the truck for more than it costs to produce. Now, because these are variable costs, the more trucks they produce, the lower this number becomes. So this is about scale. They can fix that problem by scaling. Then they have fixed cash costs per vehicle, $126,000, well under the sale price. That's fine. Then they talk about this depreciation and amortization for each truck of $459,000. So that's something that is largely accounting based, though when we look at gross margins, we don't care whether it's accounting based or not. We simply want to see a positive gross margin. What this works out to is a $400,000 truck costing $1.2 million to produce. Well, it's actually $350,000 if you do the math on their negative 260% gross margin. So this is a company that right now is surviving, not thriving. We don't invest until there's a positive gross margin, so there's not a lot to see here. What current investors need to be concerned about is cash burning. So operating cash flows tell us how much cash the company's burning. You can see along the bottom here the net cash used in operating activities. So it's around $500 million in 2023. They have less than that on their books right now. So assuming they don't reduce cash burn, they've got about 1 year left. Now, the option there is to raise capital, and at these depressed share prices, that's not a good idea. That's going to result in even further dilution. Or they can take on more debt, and for an $860 million company with $270 million in long-term debt right now, they don't have a lot of leeway there. And when you look at dilution over time, this is rather remarkable. Just look at the massive dilution that took place during 2023 as they issued shares in public offerings and issued shares for conversion of convertible notes, so to reduce their debt. And essentially, they just diluted their existing investors all to hell. So you shouldn't be surprised to see the share price as depressed as it is today. So when we look at their runway, they talk here about getting to a positive cash contribution margin on every truck as they transition into 2025. So that's the beginning of next year, a year from now. They ended this last year with $465 million after burning $130 million that quarter. And in the recent earnings call, an analyst asked them that their cash burn appears to be about $400 million for this year. Are they going to need to raise before the end of the year? The company's answer is that, well, in the second half, we're going to have materially lower cash burn than the first half, and we have assets we could sell, we could monetize. It's not a very reassuring answer. That's probably the biggest issue that we see here is a company that may not have many avenues to raise the money they need to survive. Now, when we look at deliveries for 2023, getting back to that question, how many trucks are you selling? They're expecting total truck revenue for the full year to be between $150 million to $170 million. And if you look at these numbers here, they all seem to add up. So they're guiding for full year hydrogen fuel cell truck deliveries in the range of 300 to 350 trucks. So if this coming quarter they're expecting to deliver 30, they'll need to start delivering a lot faster. They'll need to then go 60, 90, 120 over the coming quarters just to hit that lower end of their guidance on 300 trucks. That's the fuel cell trucks. On the battery trucks, they had a recall problem, batteries catching on fire, and they expect to have that resolved. So they say here, we expect to deliver at least 100 electric trucks in 2024. These deliveries will begin after we've completed the return of the recall trucks to end users in late second quarter or early third quarter of this year. So if you do the math there, you got 100 EVs times 300,000, 300 hydrogens times 400,000, you get to that $150 million. And they expect that on the low end of the guidance to have negative 100% gross margin. So still a massive problem there that they won't be rectifying this year. It's just hard to see a path towards profitability for this company that has other problems as well. So when you look at the use case, they talk about creating these hydrogen trucks that are more efficient. This is a play on the hydrogen economy, which has never really been realized, and of course, electric vehicles. Now, they talk about how customers are telling them this truck has the same weight as many other electric trucks, but it gets almost 3 times the range and can refuel faster. But here's the problem. We did a piece on the whole hydrogen economy, and unless you can input 100% electricity into your fuel cell and then get nearly 100% output, the process is entirely inefficient. So if electricity gets more expensive, this becomes more of an issue, and we certainly expect electricity to get more expensive. So the other problem here is establishment of a nationwide network of hydrogen refueling stations. Well, those ambitions are a little bit smaller now. So when you look at how they're going to set that up, they talk about an expected capital expenditure for 2024 of $60 million to $70 million, predominantly spent on their HYLA modular refueling infrastructure. So earlier this month, they opened their first modular hydrogen fueling station in Ontario, California, which can fuel up to 40 trucks per day. And customers are utilizing that on a daily basis to haul freight. And they talk about how in Southern California, they have a line of sight to secure 6 additional modular refueling sites. And also they named this First Element Fuel as an authorized fueling solutions partner. Well, how much exactly is it costing them to set up these? Who's paying the cost of transporting all this hydrogen out to these mobile stations so that these trucks can refill? Now, there's a lot of questions as to whether or not this is economically viable, and we won't be able to tell as long as they have negative gross margins. In the meantime, their share price languishes, so it's down 94% since the SPAC debut, 99% since peak, and they're looking to reverse split, of course, so they can stay listed. The interest is increasing over time. That's very surprising. Perhaps it's a combination of naive retail investors and weekend warrior traders, but we wouldn't touch this $836 million company with a 10-foot pole. Just some key takeaways here. Building a hydrogen-powered semi is tough, and what's even tougher is building one and then selling it for more than it costs to produce. So how many trucks will Nikola need to sell before getting to positive operating cash flows? Well, certainly more than the 300 and 350 they plan to sell this year. But the next time we'll take another look at this company is when they have positive gross margins, because until then, it isn't a business, it's a charity. So I'm going to put up another piece here we did on the hydrogen economy and just shooting some holes in that entire thesis. Please make sure to subscribe to our channel and support our work. Thanks so much for taking the time to watch this today.